My dear students, welcome back to our channel. In this video, I will be explaining the Bcom 6th semester subject Cost Control Management Accounting as prescribed by Osmania University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 2. The first important short question is 1. Define standard costing. Standard costing is a method used by companies to plan and control costs. In simple words, it means setting a standard or expected cost for making a product or service. Later, the company compares the actual cost with the standard cost to find out if they spent more or less. Example. Imagine a factory makes one pen. The company sets a standard cost, 5 rupees for materials and 2 rupees for labor. So, total standard cost is equal to 7 rupee per pen. But when they actually make it, they spend 8 rupees. This means they spent 1 rupee extra. This is called a cost variance. This helps the company understand where they are spending more and control it in the future. Easy trick to remember. Set the cost, check the cost, fix the cost. Standard costing helps in budgeting, saving money, and improving efficiency. It is widely used in industries to keep track of profits and losses. Next important short question is 2. Define historical cost. Historical cost means the original price paid to buy something. In accounting, we record assets, like land, building, or machines, at the price we paid for them, not their current market value. Example. Suppose a company buys land in 2010 for 5 lakhs rupees. Even if the land's value increases to 15 lakhs rupees in 2025 in the books, it will still be shown as 5 lakhs rupees. That's the historical cost. This method is simple and reliable because it is based on real transactions, no guessing. Easy trick to remember. Historical cost is the first cost what you paid, not what it's worth today. It helps avoid confusion from changing prices and keeps accounting honest and clear. Most companies use historical cost for assets because it gives a clear, unchanging record of what was spent. So, historical cost is equal to original cost is equal to actual amount paid at the time of purchase. Next important short question is 3. What is budgetary control? Budgetary control means planning your income and expenses in advance, budget, and then checking regularly to see if you are spending as planned. If there is a difference, actions are taken to fix it. Example. A company plans, budget, to spend 1 lakh rupees on raw materials in April. But by month end, it finds that 1,20,000 rupees was spent. This extra 20,000 rupees is a budget variance. Now, the manager will find out why more was spent and try to control it in the future. Easy trick to remember. Plan, compare, control. Plan the budget, compare with actual results, and control the differences. Budgetary control helps companies avoid overspending, save money, and make better decisions. It also motivates employees to stick to the plan and work efficiently. In short, budgetary control is like a financial GPS. It keeps the company on the right track towards its goals. Next important short question is 4. Standard costing meaning. Standard costing means setting a predecided, standard, cost for making a product or service. This cost is planned in advance by experts, based on past data and expected prices. Later, the actual cost is compared with this standard cost to find any difference, which helps in controlling expenses. Example. A company decides that making one packet of chips should cost 10 rupees, 6 rupees for materials, 4 rupees for labor. This is the standard cost. At month end, the company checks and sees it actually spent 11 rupee per packet. The extra 1 rupee is a cost variance. Now, they can find the reason and reduce waste. Easy trick to remember. Set the cost before the cost. Standard costing helps in planning, saving money, and improving efficiency. It is like setting a goal for your expenses and checking if you stayed on track. Many factories and businesses use it to manage their costs smartly. Next unit, 2 important long questions. First important long question is: 1. Define budget and write the objectives and advantages of budgetary control. Budget meaning objectives and advantages. What is a budget? A budget is a future plan of income and expenses. It helps individuals or businesses plan how much money they will earn and how much they will spend in a particular time, monthly, yearly, etc. Example: suppose a company plans to earn 5 lakhs rupees and spend 3 lakhs 50,000 rupees next month. This plan is called a budget. What is budgetary control? Budgetary control means comparing the actual income and expenses with the budget. If there is a difference, steps are taken to correct it. Objectives of budgetary control. 1. Planning helps in making a plan for future income and spending. 2. Coordination brings all departments like sales, production, finance to work together. 3. Control keeps expenses in check by comparing actual costs with planned ones. 4. Efficiency helps reduce waste and increase savings. 5. Decision making gives useful data to managers for better choices. Advantages of budgetary control. 1. Cost control keeps costs low by avoiding unnecessary spending. 2. Improved performance. Everyone works to meet targets, which increases productivity. 3. Better planning gives a clear view of future financial needs. 4. Team coordination. All departments follow one plan, improving teamwork. 5. Quick action. Variances are found early, so problems can be fixed fast. 6. Profit increase. By controlling costs and improving efficiency, profits grow. Easy trick to remember. Plan, compare, correct, improve. Just like we plan our monthly expenses at home to avoid overspending, businesses use budgets to manage money smartly. Budgetary control helps them stay on track, avoid surprises, and reach financial goals. Next important long question is: 2. Classification of budgets. Budgets can be classified into different types based on purpose, time, and flexibility. These types help in better planning and control in business. 1. Based on time. A. Short-term budget. Prepared for a short period like a month or 3 months. Example: a company makes a budget for Diwali sales. B. Long-term budget. Prepared for 5 to 10 years. It helps in planning big projects. Example: a car company planning a new plant. 2. Based on function. A. Sales budget. Shows how much the company expects to sell. Example: 10 lakh rupees sales in the next quarter. B. Production budget. Plans how many units to produce based on sales budget. Example: produce 5,000 shirts for summer season. C. Purchase budget. Plans how much raw material to buy. Example: buy 10,000 meters of cloth. D. Cash budget. Shows expected cash inflow, income, and outflow expenses. Example: 2 lakh rupees expected as cash inflow next month. E. Labor budget. Plans how many workers are needed and their cost. Example, hire 20 workers at 15,000 rupee per month. 3. Based on flexibility. A. Fixed budget. Made for only one level of activity and doesn't change. Example, 1 lakh rupees budget for electricity, even if production increases. B. Flexible budget. Changes according to the level of activity. Example, if production doubles, electricity budget also increases. Easy trick to remember. Time function flexibility is equal to types of budgets. Budgets help businesses in planning and controlling money, production, and resources. Just like students plan study time for each subject before exams, companies plan different budgets for each part of their work to stay organized and efficient. Next important long question is: data relating to a job are as thus. You are required to calculate labor cost variance, 2. Labor rate variance, 3. Labor efficiency variance. We'll calculate the 3 labor variances step by step using the data provided. Given data: standard rate SR is equal to 10 rupees per hour. Standard hours is equal to 300 hours. Actual rate AR is equal to 12 rupees per hour. Actual hours AR is equal to 200 hours. Labor cost variance LCV. Formula: LCV is equal to standard cost actual cost is equal to SH times SR R times AR. Substituting the values: is equal to 300 times 10 rupees, 200 times 12 rupees is equal to 3000 rupee minus 2400 rupees is equal to 600 rupees favorable. Meaning, company spent 600 rupees less than expected. That's good. 2. Labor rate variance LRV. Formula: LRV is equal to R times SR minus AR. Substituting the values: is equal to 200 times 10 rupee minus 12 rupees is equal to 200 times minus 2 rupees is equal to minus 400 rupees adverse. Meaning, actual rate was higher than standard. Company paid 400 rupee more. 3. Labor efficiency variance LEV. Formula: LEV is equal to SR times SH minus R. Substituting the values: is equal to 10 rupees times 300 minus 200 is equal to 10 rupees times 100 is equal to 1000 rupees favorable. Meaning, workers did the job using fewer hours than planned. Good efficiency. Final answer: variance amount nature. Labor cost variance LCV 600 rupees favorable. Labor rate variance LRV 400 rupees adverse. Labor efficiency variance LEV 1000 rupees favorable. Easy trick to remember. LCV is equal to total difference. LRV is equal to pay rate difference. LEV is equal to time efficiency. It's just like cooking. If you used less time and cheaper ingredients than planned, you saved money. Next important long question is: 4. The expenses budgeted for production of 10,000 units in a factory are furnished below. Prepare a budget for 6,000 units and 8,000 units. We are going to prepare a budget for 6,000 and 8,000 units based on the given data for 10,000 units. Given budgeted cost per unit for 10,000 units. Step 1. Split fixed and variable parts. Selling expenses. Variable is equal to 80% of 1,30,000 is equal to 1,04,000 rupees. Fixed is equal to 20% of 1,30,000 is equal to 26,000 rupees. Distribution expenses. Variable is equal to 80% of 70,000 is equal to 56,000 rupees. Fixed is equal to 20% of 70,000 is equal to 14,000 rupees. Step 2. Prepare budget for 6,000 and 8,000 units. We'll apply variable cost per unit times new quantity plus add fixed costs. Budget for 6,000 units. Total 9,06,000 rupees. Budget for 8,000 units. Total 12,77,000 rupees. Final answer summary. Units budgeted cost. 6,000 units 9,06,000 rupees. 8,000 units 12,77,000 rupees. Easy tip to remember. Variable costs change with units, fixed costs stay the same. Just like cooking, more food means more ingredients, variable, but same gas stove, fixed. Next important long question is 6. The standard material cost for 100 kilograms of chemical X is made up of. Calculate all material variances. We will calculate all material variances. Standard material for 100 kilograms of chemical X. So, to produce 100 kilograms, we need 150 kilograms of raw materials is equal to 800 rupees. Cost per kg of output is equal to 800 rupees, 100 is equal to 8 rupees. Now, we produced 500 kilograms, so standard material cost is equal to 8 rupees times 500 is equal to 4,000 rupees. Actual usage and cost for 500 kilograms of chemical X. Let's calculate the variances. 1. Material cost variance, MCV. Formula. MCV is equal to standard cost minus actual cost. Is equal to 4,000 rupee minus 4,504 rupees is equal to minus 504 rupees, adverse. Company spent 504 rupee more than standard. 2. Material price variance, MPV. Formula. MPV is equal to actual quantity times standard rate actual rate. We do this for each chemical. Total MPV is equal to minus 28 plus 44 minus 220 is equal to minus 204 rupees, adverse. Prices were higher overall, so 204 rupee more spent. 3. Material usage variance, MUV. Formula. MUV is equal to standard rate times standard quantity minus actual quantity. We calculate standard quantity for 500 kilograms output. Standard quantity for 500 kilograms is equal to A. 30 times 5 equals 150 kg. B. 40 times 5 equals 200 kg. C. 80 times 5 equals 400 kg. Now compare with actual. Total MUV is equal to 40 minus 100 minus 240 is equal to minus 300 rupees, adverse. More material used than standard, waste of 300 rupees. Final answer summary. Variance type amount nature. Material cost variance 504 rupees adverse. Material price variance 204 rupees adverse. Material usage variance 300 rupees adverse. Underscore 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 underscore. Easy trick to remember. MCV is equal to total loss or gain. MPV is equal to did we pay more or less per kg. MUV is equal to did we use more or less kg than needed. Just like cooking a recipe, if you use more ingredients or buy them at higher prices, your dish costs more. I hope you understand easily each question. All the best students for your upcoming exam. For other subject quick revision. Important questions. Previous question papers. And syllabus. Links are available in description. Check out once. Thank you for watching. Like and share this video with your friends.